Greetings, folks. Welcome to the Liberty Call. It's Tuesday, August 30th, 2022. We are almost at the end of the month. One more day to go before head off into September and fall and all that good stuff. And you can see my good buddy Jake back here. He is very excited again for another 15-20 minutes of financial wisdom from the beard of knowledge. So hope you're here and buckle up for some interesting facts. So pretty ugly day in the markets. It looks like most, if not all, of the major markets around the world were in the red. I see a couple greens here or there, but most of them are in much smaller places. So not real great. We're going to go through the market recap for today. Got some sort of good news on oil. Looks like it's come back down a little bit today. Job openings and some mortgage lenders are in some trouble. So anyways, if it's your first time watching, please slam that subscribe button. I'd greatly appreciate it. Give me some thumbs up, some likes, shares, all that good stuff. I would greatly appreciate it. My boy back here, Jake, would like some more dog treats. And so the more business I do, the more I can take care of him. Anyways, let's go ahead and jump in and take a look and see how the markets did today. Dow Jones was down just under % at down 0.96 or 308 points, closed at 31,790. SP 500 was down 1.1%, closed at 3986. The NASDAQ was down 1.12, closed at 11,883. Small caps were down 1.5. The VIX says it's flat. Let me go over my other chart here. Yep, the VIX was flat today. Weird. It's currently sitting at 2621. Let's go over to the other indices in the Americas. Canada down 1.63, Brazil down 1.68, Mexico down 0.86. Jumping across the Atlantic, looks like one of the few bright spots. Germany was up 0.53, while the UK was down 0.88, France down 0.19, Euro Stoxx was down 0.24. Netherlands was down 1.15%, Spain down 0.12%, Italy down 0.08%, so it was basically flat for the day. Switzerland down 0.11%, and Portugal was down 1.5%. Moving over to the Russian markets, the MOEX was up 0.45%, the RTSI was up 1.18%. And moving further east, looks like some of the Asian markets were decent. The Nikkei in Japan was up 1.14, Australia up 0.47, the New Zealand up 1.81. That was one of the big ones for the day. In the Chinese markets, the Shanghai was down 0.42, the SESE component down 0.39, China A50 down 0.32, DJ Shanghai down 0.39, and the Hang Seng down 0.37. And the Taiwan weighted came in the green at up 0.18%. So, like I said, pretty ugly day across the board. A few bright spots here or there, but nothing sizable. So, all right. Well, let's go ahead and jam through today's market recap. Dow stumble continues as tech bleeds on rate hike fears. Ooh, everybody's all scared about rising interest rates. It's terrifying. Alrighty, the Dow stumbled for a third straight day Tuesday as data pointing to a tight labor market and robust consumer confidence bolstered expectations for the Federal Reserve to stay the course on monetary policy tightening. Again, let me stop here. Why is everyone in such a hurry to, bring interest rates back down to zero and more, free money? I mean, it's not good for the economy. We've been in this situation since the financial meltdowns of 08 and 09. And we can see the long-term ramifications of this. We've had cheap lending for more than a decade, and it has created this bubble that is, at some point, it's going to just pop. And we're going to be in a real big mess. So I don't understand why the financial writers, seem to try and will it into existence that everything is okay and we can just get rates back down to zero. It doesn't make sense. All right. Job openings unexpectedly climbed back to record levels in July, and consumer confidence topped estimates to hit the highest level since May, adding further credence to the Fed's recent messaging that more needs to be, it says down, I would assume done, to slow the economic and taper inflation. New York Federal Reserve Bank President John Williams continued the recent hawkish Fed talk, saying that with inflation expected to be between 2.5% to 3% next year, again, I'll believe it when I see it, interest rates may need to rise a little bit or somewhat above 3.5% to cool price pressures. So if they think inflation is going to be 2.5% to 3%, and it's currently a little under 9 right now, just getting rates up to 3.5%, well, yeah, it'll be fine. Yeah, I don't think so. Again, you can look back at history at what Paul Volcker did in the early 80s. Interest rates had to go above the inflation rate for I'm not sure how many months it was, or, it was less than a year, but it certainly was not just a few minutes, and it was all back to normal. Let's see here. Treasury yields continue to ride aggressive rate hike bets higher, keeping growth sectors of the market sensitive to rising rates in the firing line. Big tech was led lower by a 1% slip in Apple, while semiconductor stocks added to recent lows after Citibank warned the sector could drop another 25%, pressured by lower demand and inventory overloads. Twitter fell almost 2% after Elon Musk sent the social media company another notice to terminate the $44 billion deal, and included the recent whistleblower complaint that flagged security and user vulnerabilities on the platform. Energy also played a big role in the broader market downturn, paced by a decline in oil prices as Russia pushed back against expectations that OPEC Plus was mulling production cuts. Russian media outlet TASS reported, citing an unnamed source, APA Corporation, Baker Hughes, and Halliburton Company fell more than 4%. On the earnings front, retailers remain in focus following better than expected quarterly results from Best Buy and Big Lots. Best Buy rose nearly 2% higher on better than feared results as discounts and efforts to cut costs bolstered results. Big Lots gained more than 11% after reporting a smaller than expected loss, as sales came in just above Wall Street estimates. The retailer said it expects, quote, continued significant promotional activity, end quote, with a gross margin rate in the mid-30s. Baidu, meanwhile, was down more than 6% despite reporting better than expected quarterly results and guidance that touted a recovery in demand and ad sales. In other news, Bed Bath & Beyond Inc. cut gains to trade above 9% lower ahead of its business and strategy update Wednesday. The stock, however, was doubled this month as appetite for meme stocks appeared to be back in vogue. All right. So again, some good news, some bad news. It's not the end of the world, but things are certainly not great. All right, let's go ahead and dive into some oil news. Oil dives nearly $6 a barrel on demand fears in Iraq exports. Oil fell nearly $6 a barrel on Tuesday, the steepest decline in about a month, on fears that fuel demand could soften as global central banks hike rates to fight surging inflation, and as unrest in Iraq failed to dent the OPEC nations' crude exports. Brent crude futures for October settled down $5.78 or 5.5% at $99.31 a barrel after touching a session low of $97.55. The October contract expires on Wednesday, and with the more active November contract was at $97.84, down 4.9%. U.S. West Texas Intermediate crude dropped by $5.37 or 5.5% to $91.64 a barrel, with inflation near double-digit territory in many top economies. Central banks could resort to more aggressive interest rate increases, slowing economic growth and fuel demand. The European Central Bank should include a 75 basis point interest rate hike among its options for its September policy meeting. Estonian policymaker Madis Muller said on Tuesday. German inflation in August rose to its highest in almost 50 years, data showed. Hungary's central bank raised its base rate by 100 basis points to 11.75%. Wow. It's a pretty big interest rate. Bets on another oversized Fed rate hike also boosted the dollar. A stronger greenback makes dollar-denominated oil more expensive for buyers with other currencies. Prices tumbled after comments from Iraq state-owned marketer SOMO that the country's oil exports have been unaffected by unrest, said UBS analyst Giovanni Stanovo. Baghdad's worst clash in years between rival Shiite Muslim groups continued for a second day before subsiding when powerful cleric Muqtada al-Sadr ordered his supporters to go home. SOMO said it could redirect more oil to Europe if required. Prices felt more pressure when Russia's fastest growing oil producer, Gazprom, Neft, said its plans to double oil output at its Zagrin field in western Siberia to more than 110,000 barrels per day. Investors will watch the meeting of OPEC and its allies, including Russia, collectively known as OPEC Plus, on September 5th. Saudi Arabia last week raised the possibility of production cuts from OPEC Plus, which sources said would coincide with a boost in supply from Iran should it clinch a nuclear deal with the West. Another possible supply boost, Venezuela's oil minister said the country was ready to move ahead with business with the oil major Chevron Corp, adding that progress to relaunch the operations depends on licenses from Washington. With most producers already operating at or above capacity and growing signs that the global economy may be slowing, some reduction of supply is looking increasingly likely in the coming months, said Matt Weller, head of research at Forex.com. U.S. crude supplies rose while fuel stocks fell in the latest week, according to market sources citing the American Petroleum Institute figures on Tuesday. Crude stocks rose by 593,000 barrels for the week, ending August 26th. According to the data, U.S. crude stockpiles are likely to have fallen in the week to August 26th. A preliminary Reuters poll showed on Monday. So they thought it was going to fall. It actually was up. The Energy Information Agency, the statistical arm of the U.S. Department of Energy, will release its own figures at 10:30 a.m. on Wednesday, tomorrow. U.S. gasoline futures settled at $2.69 per gallon on Tuesday, the lowest since February 16th, before Russia's invasion of Ukraine. Ooh, those mean Ruskies. All right. So, it's kind of a big, a back and forth right now. Is the global economy going to slow down to a point where oil producers are going to have to reduce supply so they don't wind up in a situation like, was it April or May of 2020? If you remember, oil was actually trading in the negative. So it's, they don't want to get back into that sort of situation. But at the same time, you have to still have enough so that the world still operates. So we'll see. All right, next up, jobs. U.S. job openings unexpectedly rise to 11.2 million, near record. U.S. job openings rose unexpectedly in July after a sizable upward revision to the previous math, underscoring persistent tightness in the labor market as employers compete for a limited supply of workers. The number of available positions edged up to 11.2 million in the month, topping all estimates from a revised 11 million in June. The Labor Department's Job Opening and Labor Turnover Survey, or JOLTS report, showed Tuesday. The median estimate in a Bloomberg survey of economists was for a decline of about 10.4 million. So they're about 800,000 off in their estimate. Still elevated vacancies and historically low unemployment rate underscore the strength of the U.S. job market. The imbalance between labor demand and supply continues to drive robust wage growth that complicates Federal Reserve efforts to tamp down inflation. There were about 2 jobs for every unemployed person in July, up from 1.9 in June. Some of the largest increases in vacancies were in retail trade, transportation, warehousing, and utilities. Arts, entertainment, and recreation also posted more openings from the prior month. So, it's kind of good news, bad news. We have a job market where, most people can find work, but there's still a lot of openings. I think it's just a matter of a lot of people don't want to work those jobs. Maybe if they get hungry, they'll change their tune. So, all right, last one up has to do with some of the lenders out there in the mortgage market are starting to go belly up. U.S. mortgage lenders are starting to go bankrupt. How this one factor could be triggering the worst surge of failure since 2008. All right, let's dive in. The real estate market just can't catch a break, with inventory of resale homes remaining low and rising interest rates making it harder for buyers to justify making the leap. And now we can add mortgage lender bankruptcies and the rise and fall of non-qualified mortgages to the factors aggravating an already uncertain market. But what does the trouble with these non-qualified mortgages really mean? And what does it mean for non-traditional buyers trying to get a foothold in the market? All right, a non-qualified mess. Non-qualified mortgages use non-traditional methods of income verification and are frequently used by those with unusual income scenarios, are self-employed, or have credit issues that make it difficult to qualify to get a qualified mortgage loan. And there's a link here up here somewhere about non-qualified mortgages. It goes into the like they said, it's basically for people who don't have a standard W-2 or have credit issues. A qualified mortgage is a very strict bullet points of things. You have to your debt to income ratio can't go over 43%. It has caps on the types of points and fees that you pay. So it's a bunch of rules that require to get a qualified mortgage, and I think a lot of those are at least somewhat backed by the federal government. Let's dive back in here. They've previously been touted as an option for credit-worthy borrowers who can't otherwise qualify for traditional mortgage loan programs. But with First Guarantee Mortgage Corp and Sprout Mortgage, a pair of firms that specialize in non-traditional loans not eligible for government backing, recently running aground, real estate experts are beginning to question their value. First Guarantee filed for bankruptcy protection, while Sprout Mortgage simply shut down earlier this summer. In documents tied to its bankruptcy filing, First Guarantee lenders said once interest rates started to climb, lending volume dropped and left the company with more than $473 million owed to creditors. Meanwhile, Sprout Mortgage, which leaned heavily in non-qualified mortgages, abruptly shut down in July. Most housing market watchers believe today's conditions, led by stricter lending rules, mean the U.S. is likely to avoid a 2008-style housing market meltdown. So that's some good news. But failures among non-bank lenders could still have a significant impact. The non-qualified mortgage share of total first mortgage market has begun to rise again. Non-qualified mortgages made up about 4% of the market during the first quarter of 2022, doubling from its 2% low in 2020, according to CoreLogic, a data analysis firm specializing in the housing market. Part of what has contributed to the recent popularity of non-qualified mortgages is the government's tighter lending rules. Today's non-qualified mortgages are largely considered safer bets than the ultra-risky loans that helped fuel the 2008 meltdown. We used to call those ninja loans. No income, no job, approved. Still, many non-QM lenders will be challenged when loan values start falling, as many are now with the Federal Reserve's move to raise interest rates. When values drop, non-bank lenders don't always have access to emergency financing or diversified assets that they can tap like larger bank lenders. Banks can also lean on safer qualified loans because they factor in traditional income verification, more stringent debt ratios, and don't carry features like interest-only payments. It's important to note that if you have a mortgage through a lender that is now bankrupt or defunct, that doesn't mean your mortgage goes away. Darn, that'd be really nice. Typically, the FDIC works with other lenders to pick up the orphan mortgages, and the process happens quickly enough to avoid interruptions in paying down the loan. While many factors drag on the real estate market, one data point carries the most significance, and that's interest rates. With the Fed's laser focus on raising rates to cool inflation, there's little reason to think that the effect on lending and the broader housing market will ease anytime soon. Higher mortgage rates, the average 30-year fixed rate was still above 5% as of August 24th, will dictate how much home they can afford. Between a potential shakeout among non-bank lenders, more stringent lending rules forced on banks, and the Fed's higher rates, there are many reasons for caution on all sides. Buyers, especially those carrying traditional loans to the offer table, will need to be buttoned up. In addition to making sure their credit is in order to meet tightening bank lending standards, they may need to consider other tactics, such as offers that are higher than the seller's asking price and other concessions, such as waiving repair costs for problems uncovered during inspection. On the flip side, sellers may be more motivated by all-cash offers, which typically speed the closing process by removing traditional mortgages and rising interest rates from the picture. As would-be sellers, they may consider waiting to list their homes until the next upswing. Despite geographic pockets of rising values and high demand, a broader nationwide cooling trend may make staying put a prudent choice. All right. So, if you're in the market to buy a house, you might want to wait a while. Again, this is all specific to where you live or where you're looking to buy. But, I personally would wait till, things kind of wash out and interest rates normalize, at least for a while. We don't know what they're going to be, at 5 years from now in the late 90s and early 2000s when, I bought a home in the 98 and then again in 2003, interest rates, you could, for a house, I think was probably between 5 and 7%, depending upon, the going rate at that time. And no one considered that abnormal. My parents, when they bought the house that my father still lives in, I think they paid 12% in 1978 for their for the house. And again, they had good credit. So, that was just normal at the time. So, we've been very, what's the word I'm looking for? Spoiled to have such a low rate environment for, 14 years now. And, so we go through these cycles. It's not to be unexpected, but like I said, as home prices start to recede because of, the rising rates, might want to wait till the bottoms out or gets to a point you're more comfortable with. Now, if you're a seller, you're seeing your equity disappear as the market rates fall a little bit. So again, it's a give and take. You have to make that decision. So, all right. Well, that's everything I had for today. If anyone needs anything from me or you'd like to book a meeting, please go to dsafinancialgroup.com. My email address is right here on the screen. If you wanted to shoot me an email direct and say, hey, I need to get my finances in order. Let's find some time. I've always got time for people who need help. All right. Well, like I said, that's everything I had. If anyone needs, go to dsafinancialgroup.com. And I'll be back tomorrow with Wednesday's Liberty Call. And we got an Astros game tonight. They were off last night. And JV went on the IL. That's, thank goodness it's just a calf strain. I haven't read any other news that was anything more serious. So give him 2 weeks off. He'll be back slinging bullets in 2 weeks. So we'll be all good. So hope everyone has a great night, and I'll talk to you tomorrow. Bye.